One of the most difficult market conditions is the notorious sideways market, which can affect trading performance if you fail to adjust accordingly. In this video, I will share a step-by-step process to help you tackle a sideways market for potentially better trading results. Step number 1 is to learn to identify a sideways market. This step seems intuitive and obvious, but is often ignored by traders. A sideways market is obviously one where price action will not roll into one definitive direction, up or down, but run side to side through short bursts of movements up and down, reflecting major indecision in the market. A consolidation or sideways phase in the market may be easy to spot, even for newer traders, when it has already formed, but can be a real challenge to spot, as it is forming when the market is transitioning from a trending phase to a consolidation phase. It usually takes traders quite a few losses before they eventually realize the market has lost the trend and the decisive direction. Contrary to a trending market, a sideways market will often comprise of brief periods of strong price action in one direction that will often reverse shortly after, usually from short-term support and resistance levels formed recently. As illustrated in this example, many short-term levels in a narrow range form a key characteristic of consolidation phase themselves and can be early indicators of a market that could possibly be transitioning into a sideways phase. On the contrary, a strong trending market will usually pack enough strength to push through minor areas with relative ease. Step number 2 is to define the range. Once you have identified that your market is in or is entering a consolidation phase, one of the first steps to take is to clearly establish the limits or the range of the consolidation phase itself. Usually, these phases will have a clearly defined upper and lower range, marked by either side-to-side support and resistance levels or angular trend lines and channels. Identifying the range is practically marking out your battlefield, meaning how much of a playing field do you actually possess. And this is very important because a consolidation phase that is too narrow is not worth trading at all. You need ranges wide enough to allow you to trade with caution. The wider the range, the more space you technically have to take and manage your trade. In a very narrow range, as the one in this example, trading could be more risky as trouble areas and potential support and resistance levels could be grouped very close together, making it hard to expect much from price movements. Defining the range gives you a more clear perspective of the bigger picture. Knowing the upper and the lower limits of the trading range also allows you to watch the range itself for a potential breakout to either side. This is especially useful when the top and bottom levels of the consolidation phase are defined by angular trend lines, like in a wedge pattern that is slowly constricting price action, leading to a possible breakout. Next step is to identify the mid-range and other internal levels of support and resistance. The next step is to highlight all the areas within the trading range that could potentially cause price to hold as support or resistance. The key here is to identify all levels. Often, traders will concentrate on the larger and more obvious regions, which, in the case of consolidating markets, is often just the top and lower end of the consolidation range itself. The trick is to identify all levels of potential support and resistance. In a weak market that is struggling for sustained momentum, even the minor areas of support and resistance can cause the price to hold up. Hence, all possible trouble areas, major and minor, need to be settled in your trade management and planning phase. While doing so doesn't entirely eliminate the notorious surprise factor of sideways markets, it does eliminate a lot of ambiguity around the seemingly unpredictable price action. Of prime importance in a sideways market is often the mid-range of the area. The mid-range tends to act as a pivot for the price as it moves back and forth from the consolidation range. This is basically the 50% Fibonacci level between the range high and the range low. Generally, above the mid-range, price is bullish, and below the mid-range is bearish, and the range high will act as resistance, and the range low will act as support. Now, even though you have established all the possible areas on the chart that could potentially cause trouble for the price as it hits these regions, you need to factor in the uncertainty that comes along with trading in a weak, non-decisive market. Just as the price can bounce and spike up and down the short and long-term levels within the consolidation range, it may still be prone to spikes and otherwise strong and sudden periods of sharp movements in either direction of a seemingly clear level within the range. This likelihood calls for a safe and conservative trading style, whether that involves placing conservative stops on the chart, using trailing stops, watching the trade live if you day trade or scalp the market, or taking quick profits at brief intervals. You must take all the actions necessary to safeguard yourself from reversing market action. Take a look at this example of a seemingly unpredictable bounce during sideways market action. Notice how the price pulls back from the region marked with this circle, even though it would be hard to categorize this area as a clear support and resistance level. We are well under the top end of the range and also further away from the mid-range support and resistance level. It's these kinds of pullbacks that require conservative trade management when the market is choppy and undecisive. You need to find a balance between aggression and conservation. While it's very important not to be over-aggressive when trading a sideways market, it is also just as important not to be ultra-conservative either. In a sideways market, because market sentiment is weak, managing the trade too tight can often result in a suffocated trade, as price whipsaws within the trading range, bouncing off minor and major support and resistance levels found internally within the range. For example, moving the stop to break even as soon as the trade moves in a sideways market holds a very strong chance of hitting it. The strategy could well have been intended to safeguard against choppy price action, but ultra-conservative trade management doesn't help record consistent results in a sideways market either. It's easy to see how several trades executed in a sideways market, each resulting in either a break-even trade or a minor loss, because of adopting an ultra-conservative trade management, would not be benefiting your account equity much at all. In fact, for such a trader, avoiding trading in a sideways market altogether might actually be a smarter move, as this eliminates the risk entirely. But for other traders who wish to improve their sideways market trading skills, it's crucial to find the perfect balance between aggression and conservation when it comes to trade management. Sometimes a chart can look messy, and it can be difficult to choose a range high and range low. It can be just as simple as picking the range that fits the best. Try different possibilities and see where and how the price reacts to a certain level. Also, look for confluence. If multiple important levels line up, it's more likely price will reject or bounce at that level. This confluence can include an important support or resistance level, or even a moving average if you use one. There are many ways to trade a range, but let me share the strategies that work for me. The classical trade is to search for price action patterns at the upper and lower levels of the range, trading the bounce from that levels. My favorite range trading strategy is fading the breakout. You need to search for this scenario: a low broken after a down move, or a high broken after an up move. Next, I wait for a close back inside the range, or even a retest. Stop loss below or above the failed breakout, meaning the most recent low or high, and I target the range high or low, depending on the case. Also, if the range is wide enough, trading the mid-range can provide high probability setups. Above the mid-range, price is bullish, and below the mid-range, price is bearish. And here's an important tip: even though we are in a range, the previous trend of an asset is obviously very important. A trade that goes with the recent trend is more likely to play out compared to a trade against the trend. I prefer to trade range setups that go with the previous trend, so they have a higher probability of playing out. Trading a range can just utilize support and resistance levels, but it can also involve the use of indicators. Such technical indicators, like the relative strength index or the stochastic, can be utilized to confirm the overbought and oversold conditions that often follow price movements at the top and the bottom of the trading range. Or they can reveal a divergence at the top or bottom of the range, which can be a powerful sign that the range will hold and the trade inside the range can be taken. Range trading is a very useful skill to have because most markets don't trend all of the time. If you correctly identify the range, time your entry, and control your risk exposure, you can make some decent profits even if the markets are not moving decisive in one direction. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel and click that bell icon to stay in touch when we release new videos. Until next time.